Okay, another FOMC behind us, and the decision was for nothing, no change. The probabilities from CME were basically 100% on zero, and that's what we got. So let's go through the press conference. A couple of interesting questions, but overall, he really avoided geopolitical questions, and he didn't really get into too much detail about rates rising at the long end of the curve. Was the first question down here, and he read what seemed like reading from prepared remarks. He said, "First, let me set some context." And he was fully expecting that question. His opening remarks, they were long this time. He really went on. They're squarely focused on our dual mandate. The stance of policy is restrictive. The full effect yet to be felt. So he's pointing here to lags. This opening part, as he was going through it, I got the feeling that he was in his way communicating that they're done. They are restrictive, and the full effect has yet to be felt, which means we can be patient and wait, which is what he said next. We are proceeding cautiously. Later on, he said we are proceeding carefully. Economic activity well above expectations. Housing, business, fixed investment are both down. Immigration has rebounded to pre-pandemic levels. When he started talking about the participation rate having moved up over the past little while, and that he thinks that because immigration has rebounded, that will alleviate some wage inflation pressure. First question went to Reuters. Long-term bond yields, did they affect the decision? And his answer is a higher, longer rates, strong U.S. dollar, weaker equities could matter for future rate decisions. And there's the biggest word in the English language, right? If they are persistent and they are not merely a reflection of expected monetary policy. By that, he's saying, listen, if you have higher, longer rates, stronger U.S. dollar, that's really just the market expecting a rate hike. And if there was no rate hike, this would just disappear. Then they would not be persistent, right? They're not merely a reflection of expected monetary policy. And then he said, it doesn't currently look that way. Higher rates are having an effect. New York Times, if you pause in December, are you done? Or is there more next year? And if so, is there a cost to taking a more extended pause? We have not made a decision about December. We did not even discuss it. And no, it's not an issue to raise again after any extended pause. Next, Wall Street Journal. Did the Fed staff put a recession baseline back into the projections? There's question one. Question two, how much do higher long-term yields translate into a rate hike or translate into rate hikes? And he started off by saying, I don't want to answer your first question. And he says, well, I guess I have to now. The answer is no. I don't want to answer your question. Well, I guess I got to now. No. Translating into rate hikes, just don't know. But financial conditions have clearly tightened. This is beginning to sound like a Fed who is done. Follow-up question, what makes you confident that higher rates will work? You've gone 500 basis points, you've got QT, you've had a minor banking crisis, and look at the GDP that we just pulled out, 4.9. Doesn't look like they're working. And he said, lags, dude. Plus, you can see the effect now, but yes, it's a surprisingly resilient economy. Financial Times, more than one rate hike necessary. In the future, that is. And he says, if the data suggest it, follow-up question is, would you see rate cuts? Not thinking or talking about rate cuts. The next decision is how long to stay restrictive. So he says, we're in phase one, which is how far do we go? And we don't know if we're done with that. We feel that it's sufficiently that we are in restrictive territory. Sorry, he didn't say sufficiently. We are in restrictive territory, and we reserve the right to go further if we want. The next phase will be how long do we stay there? We're a long way from rate cuts, which would be the third phase. CNBC, is there a tightening bias on the committee, or is it more neutral? And he says, going back to the other one, that they are in phase one. The question we're asking is, should we hike more? We're not even asking the question of how long do we stay at this level. So I'm not quite sure how he was answering that. I think he didn't want to say one way or the other. Associated Press. The UAW strike is over. Oil prices seem to be leveling off at a higher rate. The Israel-Hamas war is occurring. How do you see these effects, or how do you see these affecting the economy going forward? And he didn't really answer it. He just, we're making process on inflation. That's our focus. I don't think he wants to wade into any comment whatsoever about any geopolitical event or anything to do with labor. Washington Post, is pain in the economy still necessary to get inflation down? The current economy is historically unusual but welcome, but we feel it is still likely to be true that we will need to see some softness in the labor market and slower growth. Question, what about lags? Very hard to know. Complicated by debt that was termed out at lower rates. I guess the question here, when I say what about lags, the question was how do you see lags playing into it? Trying to get to, I guess, to some measure of, well, what are the lags? How much is still in the system? Hard to know. Bloomberg, Mike McKee picked up on this, and he wanted to clarify that. He said slower growth or below trend growth? You've always said below trend growth, but you just said slower growth. Which is it? And then his real question is the dot plot out the window, because the dot plot showed one more rate hike at the end of the year, and you paused in September. You paused now. If you're not going to hike in December, do we ignore the dot plot? And he answered dot plot first. He said, it's a picture in time. It's not a plan. It's a forecast that could change. Decisions are meeting by meeting. And in terms of slower growth, it was a long, kind of convoluted answer, but he made reference to short-term growth and long-term growth, or potential growth, saying, we think it's somewhere around 2 or slightly below 2. But in the short term, potential growth could be much higher, and that's probably what we're seeing now. It could be that short-term potential GDP is actually higher, and that we may be below that now. So we may actually be below trend if we consider that short-term potential output happens to be higher right now. Still don't know if that answered the question, but I guess he was trying to defend his below trend growth, and he's saying, well, maybe we are below trend. Are higher long-term rates affecting decisions about QT? We're not considering changing the pace of runoff. Next, Political asked a question about Basel III. It's an odd place to ask a question not related to the event that you happen to be there for, which is monetary policy. But asked a question about Basel III. Could you accept finalizing that proposition without significant changes because it's out for opinion right now? And his answer is we will come to a consensus. If the feedback we get is meaningful and implies that we should move somewhere, we'll do that to get to a consensus. NPR, let's just jump there, had another question that had absolutely nothing to do with the event you showed up for. Debit card fees, I just went blah, 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 time for a bathroom break. NPR last time asked a question that was blah, blah, blah as well. Somebody should tap them on the shoulder and say, you know, this is because there was an FOMC meeting today, right? I mean, you are aware that there was an interest rate change or a decision on interest rates, and that's what everybody's concerned about. You are aware of that, right? I mean, this is a question that could be handled in an email, just letting you know, buddy. Thanks. Maybe somebody should just tap them on the shoulder and let them in on that. But anyways, Politico and NPR in the wrong room. Bloomberg, other than long-term yields, what else are you watching? This wasn't Mike McKee. It was somebody I had never heard of. Other than long-term yields, what else are you watching? Could these long-term yields affect banking stress? Which I thought, okay, well, that's an interesting question. But, I mean, what else are you watching? What kind of answer do you think you're going to get there? We look at a lot of things. And banking stress, something we're watching. The banking system is quite resilient. I was waiting for him to say that. No reason to think these yields are changing that picture. I don't think he's going to show his hand on that one at all. But I think it's it's good to get that question out there. Could long-term yields affect banking stress? Because we've just had a bunch of earnings, and there seemed to be a lot of focus on the unrealized losses in the treasuries that the bank is holding. Now, if it's in there held to maturity, yeah, of course they're going to be sitting on unrealized losses, but it doesn't matter because the intent in buying them was to hold them to maturity. And as long as they have liquidity, it doesn't matter. And the bank funding program that was put in place last March is still in effect. It was a one-year program. It's still in effect, so it doesn't really matter. Later on, there is a question about that March deadline coming up. Fox Business 2% target. Inflation is now over 3%. No rate hike today. How long would you be? That should say comfortable. How long would you be comfortable with inflation over 3%? And his answer was, "We are making progress. These things do take time," but didn't really answer anything in terms of how much time. But I don't think he's going to give anything away. Not because they have a big master plan or secret plan, probably because they don't know what their plan is, and they are truly going meeting by meeting. So he can't say, well, we think 6 months. If it doesn't move in 6 months, we'll move. I don't even think they're having that conversation. Follow up. You said doing too little is worse than doing too much. Are you not doing too little right now? And he said, yeah, I did say that, but risks are more two-sided now. A couple of good questions near the end here. The Economist, bank resilience is most likely due to the bank term funding program that you had put in place last March with the bank failures. How likely is it that it will need to be extended in March? Which is sort of looking ahead saying, well, hey, listen, this is a good question. If they are thinking that they're going to have a rate cut before then, it's probably not likely that they'll have to extend that. Maybe I can get at what their plan is for rates by asking this question instead. Answer, haven't been thinking about that yet. He says it's, November, that's all the way to March. We haven't even been thinking about that yet. Follow-up question, Michigan consumer sentiment. There was a big jump in one-year inflation expectations. You said last year it was a reason to hike. Is that still the case? And his answer is, yeah, I remember saying that. He said that got blown way out of proportion. He says it's one thing that we look at among a whole bunch of other things. I simply just said, if you look at the data right now, for example, this, and he says it got really blown out of proportion. He says we look at a lot of things. So he's sort of downplaying that one. Barron's right out and said it, is the neutral rate higher, which is becoming a louder part of the conversation, is that given 4.9% growth in the third quarter and a strong consumer, the neutral rate must be higher. It's an important variable, but it is unobservable. He says think about it more of a range, and that he feels that the rate right now at 5.5 is within that range. Wherever it happens to be, we're in the range. Follow-up, wage inflation. Are you concerned about that? Wage inflation is, and this is good coming off the back of ECI, because ECI, the market felt it came in hot, and it didn't like the number. And bonds sort of just gave up the ghost that day. Wow, I mean, they give up the ghost every day, but they gave up the ghost that day. Wage inflation has come down significantly over the last 18 months, much closer to being consistent with 2%, get rid of that B, 2% inflation, both the ECI and the average hourly earnings. I think wages I don't think wages have been the principal driver of inflation, sort of taking the focus off of ECI and AHE. Right there, and it was around about this time that bonds really started to get a bid. Marketplace, are you concerned about overshooting? Are you as concerned about overshooting as you are about getting inflation to the 2% target? And his answer kind of echoes this. This was sort of a variation of a question asked earlier, and he said the risks are more balanced now, so it's not that one is more worrying than the other. CNN, any structural change that is pushing up consumption, in GDP. which I think is a good question. If we look at U.S. demographics now, it kind of looks like this, where this is the retirement age. If you look at 0 to 5 years old, 5 to 10, once you get to 65 and older, it is a large cohort. That is a structural change because they're drawing down their portfolios of savings and spending, but they're not creating. They're not adding to output, but they are consuming output that everyone else is adding to. And remember, aggregate incomes equal aggregate output equals aggregate expenditure. Well, they're not earning incomes, but they are taking the output. Along with everyone else who's earning an income, feeding off the same output, that would be inflationary. That would be a structural change. Not really. It could be strong balance sheets. It could be extra savings left over from the pandemic. Could be strong job creation. Incomes are now greater than wage gains are higher than the rate of inflation. So you have increases in real disposable income. Supply is better. Could be any of those things. And then he said, and even with all of that going on, we're still making progress on inflation. This one here, never heard of. Agency France Press. Israel, Hamas, risks to global economy. Could we see a surge in oil prices? How's the Fed monitoring this? And he did. This was brought up a couple times, and he just avoided the whole thing. And he did a pretty good job just not making any comment on it whatsoever. Not clear at this point that this would have an economic effect. It may or it may not matter to the FOMC. I think that is the most detached, neutral answer you could get that can't get you in trouble. That's not a lie. It may or it may not matter. With all of that, I get the real impression that they are done. I don't know if you walk away with the same feeling, but just based on his answers, I do get the real impression that they feel they are there, that they are in restrictive territory, and now they're probably in December moving into the decision phase of, well, okay, now how long do we stay here? The market has, if we look at Fed funds futures or SOFR futures, has Q2, Q3, and Q4 each with the implied prices on the futures are implying three cuts next year, one in Q2, one in Q3, one in Q4. And in December, we're also going to get new summary of economic projections and a new dot plot. And if that dot plot does not show another rate increase, then yeah, they're in that second phase. They may in December signal that they are in the phase now of how long do we keep rates at this level. But I personally think they're done. Also, if we go to Bank of Canada, I think they're done as well. And I think Bank of Canada is probably going to cut sooner than the Fed is going to cut. But we've seen a number of central banks on pause now. That this may be done. We may be at peak rates for the most part globally. Bonds got a good bid today. And then after the market closed after 4, that bid continued on, which, we're not really going to know about bonds until Friday. We're going to see the jobs report. If the jobs report comes in under 180, like 140, 150, I think the consensus will be that, yeah, that's pretty much it. I think they're done. And based on the way he was answering these questions, I think he's done. Besides, he gave away a big signal. He did not come out with his iPad. And the iPad usually means that he means business. Well, he came out all casual and everything, a folded up piece of paper. The guy's got no stress on him whatsoever. He's looking good hair today. Wasn't all over the place, composed, calm. Yeah, I think he's done. And that means I'm done here too.